Okay, hello, good morning, guys. So I'm going to continue from where we stopped. So today, I think I'd just like to take you into the charts today. Maybe share a couple of things about, you know, liquidity. Okay, yeah. So I gave you an assignment. Go over to my Discord. Seen this yesterday. Yeah, so I don't need you to make comments in the assignment area. Just submit the assignment there. There's no need to say anything in there. Okay, so I'm going to be deleting all the comments there. Ooh, I think this is not a comment. It's an image, but it's truncated. So you can see I'm not seeing it. I don't know why, but the ones that I can see are clear. So you might have to resend. Please resend. Please resend. The other ones. Okay. So this is inducement, engineering liquidity. Yeah, I agree with this. Yeah, go from high to low to lower high to lower low to higher low to lower low. Break of structure. This is the inducement, the first attempt. All right, the first attempt is the inducement. These ones are just other internal liquidity, right? They are internal liquidity. I'm gonna give you all those variations. Excuse me. I'm gonna give you all those variations. Then the extreme one is, see guys, this is not the extreme one actually. The extreme one is somewhere here. Look at it. You see, there's a valid pullback here. This first one is not valid. From this high, the first pullback is here. This is the first one. Yes, this is the first one. So this is the correct engineering liquidity. So you still have other pullbacks, yeah, but the extreme one, the first pullback in this downtrend is the extreme liquidity. That's at the end of the day when the pullback begins. This is the extreme one, the last one before you have your swing, right? That is the engineering liquidity. Okay, because the idea I think is if the market comes all the way in here, right? If it comes all the way in here, it is taking the last people and it's going to have enough strength for it to push and break structure. So that's why we call it engineering liquidity, right? There might be other reasons, but that's the only thing I can make up as to why the word is engineering liquidity. I did not make most of these words, and I try to stick with them as much as I can, so that if you do your additional research, or you hear these things elsewhere, you are not perplexed, right? You don't mix things up or get confused, right? That's why I try to use it as much as I can. Okay, but more than anything, you need to understand what you are actually doing and what you're actually looking for. This is the engineering liquidity, not this one, because this is the last one. Okay, this is the last one. All right, you might be saying, yeah, there are other ones. So I mean, see, you have 1, 2, 3, 4, right? Even 5. Or this is not valid. This last one is not valid because the red bar is the smallest, and it wasn't taken out, right? So this one, the red bar is the lowest, but it was taken out somewhere here. So this is your first one, and this is your inducement. All of these ones are all internal liquidity, all, right? But we now agree and say that out of all the internal liquidity, the first one that you experience when the pullback begins is called the first one that's going to make this pullback valid. Once the market taps it, it makes the pullback a valid pullback. The market can just take the first one and resume, or take the second one and resume, or take the third one and resume, or take the last one and resume. The main thing is know which one is which, and which one is going to give you high probability. That's what we're saying, right? So if you're going to take the first one or the second one or the third one, you're going to have to adjust your risk, because you know that there is an extreme liquidity here, the engineering one, that the market might still, try to go back to, right? So even if you had changed your chart to the line chart, I'm sure you would have taken notice of, because I can see your line chart here, right? You're only taking this first one, this one that you marked, and this other one, right? So the first thing, that's why I took my time to teach you what a valid pullback is. I did not do it because I just wanted to do it. A valid pullback can be one bar, one simple bar, only one bar. Some people just they don't have any rule whatsoever, and they just do whatever they like, and that is wrong. Okay, there is a principle for what a pullback should be, and I already explained it. If you did not get it, go back to the previous video. It's very clear in that video, right? Some people say, okay, let it be 30% pullback, let it be 23% pullback, let it be 40% pullback before we say yes, it's a valid pullback. Or some people will say just eyeball, but you can't work with that, right? You can't work with that. The best thing, which is the correct thing, is an actual pullback. When the lowest point goes in, right? The lowest point, the market makes the lowest point, starts to retrace. Once it starts to retrace like this, and that lowest point is taken out, that is a pullback. Whether it's 10%, whether it's 50%, whether it's 80%, it is a pullback. And as long as the market does that thing and now resumes and takes out that low, you now have a valid pullback. So take note of that, right? Take note of that. That's that one. So here, whoa, this is this coming from who? This is Pelumi. I think Pelumi looks like he already has a couple of experience, because I can already see, the entries here. Very, very correct. Very correct. You have a sweep of liquidity here. I'm going to teach that. This is called transactional liquidity. Is the liquidity that comes from break of structure. So you have a sweep of liquidity at the extreme point here. Market breaks, changes character, okay, because we are assuming that it is reacting from something from the higher time frame, right? So there's a change of character. There's a break of structure which is invalid. Okay, I'm going to teach you. No, not invalid, right? Which is not yet confirmed. That's the word, right? Not yet confirmed. Okay, I told you yesterday that the break of structure, I like to use the arrow so that I can remind myself of where the break of structure is tapping into. Is it tapping on the body of the candle, or is it tapping on the wick? Yesterday I mentioned, I told you, we're going to see the break of structure. At what point do we say yes, the structure is truly broken? Okay, so is this a break of structure? Is it reacting on the wick? If it is reacting on the wick, it's a liquidity sweep, right? It's a sweep. But if it's reacting on the body, then it's an actual break. Okay, so if we have it touches the wick, but then the next candle still breaks that wick and continues downward, then we still have a valid break. Okay, so the point here is, what is it reacting to? If you observe very well here, he has used X to show that it's a sweep, right? It's a sweep. And one thing I know, or at least you will observe as you continue to go further, is the moment there's a sweep here instead of a break of structure, right? The moment there's a sweep here instead of a break of structure, the market is going to reach out for the liquidity on the other area. Okay, it's always almost like that. If you look at the current price action on EUGU, you observe that the break of structure reacted from a week, and since it reacted from a week, it was bound to go back to take out the either the external liquidity or internal liquidity on the opposite area. Is that okay? So here you can see that that's exactly what happened. And when that happened, we now had the valid break of structure, right? We now had the valid break of structure here. Okay, so yeah, so I really do agree with this. And to cap it, this is really correct, right? This is correct. Okay, first here you have, you can see that this is not a valid pullback. Here is your first valid pullback, right? First valid pullback. And that's the inducement. Okay, and then what's this? This is another valid pullback. Look at it, market pulls in, comes down. Look at it again, the market pulls in, comes down, right? This is still the inducement. All of these are internal liquidity. All are internal liquidity, right? And then what do you have here? Again, this is the extreme one. Now you can see this is the first one. And what did the market do? The market can react from the first one. The people who think that, you can see why I do not favor the first inducement, right? You see why I don't favor it? The market can react from it, but it will not get to target, right? It won't get to target. Look at the second one here. The market reacts again, right? It reacts again. It doesn't get to target, right? It doesn't get to target. I'm not saying that that's how it's going to be all the time, right? I'm not saying that's how it's going to be all the time. I'm just saying that that's what happens, right? That's what happens. That you are better off waiting until the extreme one, which is the engineering liquidity, is tapped into. You can see what the market did here, right? It taps into that area. It does not take out the valid swing. It only comes in between the valid swing and the engineering liquidity, which is the extreme level of that inducement, right? This is a very good example, very good example, because it just you can just see how this thing prints, right? It just goes from the point where the extreme liquidity is tapped into. You can either take your entry directly from here, or you go into the lower time frame. This is what time frame? 1 hour time frame. So if your higher time frame is 1 hour, then your lower time frame should be 5 minutes. So you go into the 5 minutes to look for an entry. I'm going to teach you entry. I'm going to teach you how to take entries so that you have higher precision on the entries. All right. And then I still have to teach you what we refer to as other blocks. Other blocks, demand, supply, all the things that you need for you to take the entries. Okay, so this is a very good example. And then you can see that even if you do not have any idea about the precision entry here, right? You don't have any idea about precision entry. You could have just said, okay, this is the engineering liquidity. I'm going to put my entry from the engineering liquidity all the way to the swing, the protected high, right? The protected high, where you have the valid high. So what do you want? What do you want from here? From here, stop loss. From here, entry, and then target here, right? So from here to here, you should be getting at least 1:4, right? 1:4. Then when I teach you how to get a good entry, a precision entry, right? You can take the precision on the bar. See the highest bar here. This highest bar, right? That's the bar that swept liquidity, is the 1 bar order block, right? So you can take from here like this straight. That's your precision. Okay, so you have, usually if I take this kind of entry, I'm going to take one entry based on the entire area, and then I take another entry based on the precision, right? Based on the bar precision. Okay, so the one I have here will be a bigger lot size, while the one on the entire area will be a smaller lot size. The reason I do that is because most times the market will give you a reaction. Okay, once the market taps your order block, if it's valid, it will give you a reaction. Okay, so I want to get at least 1:3, all right, on that precision entry. Okay, then the one that covers the entire area, I allow it to go all the way to target. And then at the end of the day, what you see is I'm still risking, if I want to risk 1%, I'm still risking 1%, but I'm making sure that I take money as the market presents it to me. All right, I take money and I'm not worried about my risk on the trade. Okay, so I'm still going to teach you more I'm going to teach you more on entries and all of that, right? So, but we're going to be taking it step by step, and I need you to follow me along every process. There's still a lot that I need to show you. Okay, everything we're doing so far is just the introduction, right? It's just the introduction. It's the basics. Okay, it's the basics, right? I'm gonna show you every single thing, and like I always say, right? Like I always say, please guys, I don't need you to make any comments here. The only thing I want to see here is just the assignments. Okay, just post the assignments here. Don't say anything whatsoever. Just post the assignment. All right, that's why we have different sessions here. We have different sessions. If you want to chat, go to the chat. If you want to ask a question, go to this place and ask your question. If you need to make a reference, maybe you have a picture or something, add it there and ask. Okay, don't interrupt my flow here with the comments. Okay, so use everything. I'm still, I'm still working on so many other things, right? But I'm going to do a guideline as to how you can use the entire the entire channels here. All right, so the first thing I want to put across is to ensure that we have, we have the what we're working with, right? So once we have established that, the next thing is everybody's going to go and back test. We're going to do division of labor. Everybody is going to go and back test their own pairs, their time frame, right? And then we'll come back and look at all the data together. All right, and then after that, we now come over to where we have the watch list. The watch list will be reserved for me alone, so that I can share some of the levels that I'm looking at, right? And then here is the chartist. It's for everybody. If you are confident enough, you have a level that you are looking at, you come to this chartist area and then you post it there. All right, this area is going to be reserved for me. I'm going to post all the levels that I think are very okay. When I look at the chartist area, if I think that the level that you are giving us on the chartist area is valid, I will bring it over to the watch list. Okay, so that is, yeah. Okay, so where was I? Take this one next. Right, so here you have what do we have here? So this is double bottom. This is double bottoms, right? There are different types of liquidity. That's what I'm going to just teach you, so that you can know all these things along with the other guys out there, right? So that they are not talking and then you are looking at them and saying, oh, what's that, right? So you understand the concept. You also need to understand the terms, right? The terminology is going to help. So what do we have here? We have double bottom. This double bottom is the I'm not seeing this thing very well, but I'm assuming that this is double bottom. It was not labeled. If he has break of structure, that means this is not double bottom. This is the pullback that was taken that made this a valid swing. Is that okay? So this is inducement or pullback on the previous leg that was taken. And then what do you have here? This is sweep, right? This is sweep. So you have pullback, sweep. It makes this valid. Once it breaks structure, it makes it valid. And then look at the break of structure here. You have the market reacting to the body of the candle, not wick, right? To the body of the candle. So you have break of structure valid. Now you have the first pullback. First pullback moves again. Second pullback moves again. This guy did a good job. Who's this? I think it's the same Pelumi. Okay, I think Pelumi has a little bit of experience, I would say. he's the one that just joined us recently. He has a little bit of experience with this. So that's a good one. That's a good one. I usually encourage a lot of teamwork, right? Because the idea is when you teach someone, you learn more, right? Those of you who some of you are really new, and I might not be there. I mean, it's like having just me working one-on-one with everybody. It might not be very easy, and the one-on-one is different. In fact, I had to stop it because it was taking my time. The money was good, but I had to stop it because it was taking a lot of my time, you know. So I know that it's very the efficacy of that thing is good, right? So what I want to do is we're going to grade everybody, right? So like I said, we're going to have a CA. We're going to have a CA. Now, no matter what you're doing on that CA, do not get below 50, because if you get below 50, I'm going to remove your access to the premium area. All right, and I'm going to do that. There's nothing you can do about it, okay? Because I'm taking it that you are not serious. All right, so you just stay with every other person, take the free stuff, okay? So if you work on these things exactly how I've given to you, and then you can ask questions. You can ask questions if you have any challenge. So I don't see any reason why you score below 50%. All right. You can see what we have here. We have two pullbacks. It means that the first one, the recent one you have here, is the inducement. The extreme one is the engineering liquidity. Okay, this is your valid protected low, right? And I don't know for sure if the extreme liquidity was taken. Okay, but this is the reason why you give the swing structure a little bit of breathing space, right? So that if the market intends to take one pip below that swing structure, right, it doesn't stop you out. This is called external liquidity. If it is actually taken, it's called external liquidity grab. Okay, so once the market takes the external liquidity grab, is done, right? How do you know it's taking the external liquidity grab? When it's a wick. Once it taps it, you can almost guarantee that it's gonna get to the extreme the external liquidity on the other side, which is the break of structure. All right, so this is see what we're saying, right? This is called expansion, right? See what we're saying. First, this one, the probability of the first one is low. The probability of the extreme one is high. The probability of the actual boss, that's the swing structure, the defender, the protected level, if it is weak, the probability is the highest. I hope you understand what I'm saying. So you can say this is maybe 20% probability from the inducement, right? And then as you go down, you can now say, okay, we have about maybe 40%, right? Probability, 60% probability, right? When you now come to the extreme one, you now have like 80% probability, because if there's a weak here, there's a very look at the force, right? Look at the force. It almost gives you no opportunity to buy on a pullback, right? To join. There's almost no chance for you to join. This is just one move. All right, and then it continues again. It makes this now what? This is what? Valid swing structure. This is a valid swing structure. So what do you have again? Market gives you the first valid pullback here, pushes again, gives you another pullback, pushes again. What do you have again? Inducement, engineering liquidity. Inducement, engineering liquidity. This is the engineering liquidity because there's no pullback here. And mind you, this is a valid structure because it has tapped into the pullback here and it has gone. So if you miss this area, you have a fresh opportunity to join. So once the market breaks structure and then there's a body close, all you need to do is wait for the pullbacks to be taken. Immediately the market comes now and exceeds the inducement area, this becomes the valid break of structure area. That's the valid higher high. What are you waiting for? You're waiting for what? The engineering liquidity to be taken. Once the market takes the engineering liquidity, you can start to position yourself for what? For a buy, right? You can position yourself for a buy, and then what do you expect again? The market will go all the way, break the structure again. As long as it's the body that closes beyond that place, what you have is a valid break of structure. If it is swept, meaning wicked, if it is wicked, then you have a liquidity grab. It's called transactional liquidity, right? You have a liquidity grab. Okay, so and if that happens, there is a high chance of the market taking out the what's it called, the serving, that's the valid swing, right? Once there's a sweep here, just know that there's a high chance that the market is going to take all the internal liquidities and probably external liquidities, right? And that's what you can see here. Okay, so this now it's assumed that the market has taken this liquidity, right? You can see we still have it's still the same thing here, guys. It's still the same thing. Who is now the swing? This is the swing, right? Because this is the person that took out the engineering liquidity here. It's the one that took out the engineering liquidity. Takes out the engineering liquidity, and then depending on which of these two is lower, you have your swing. If this is lower, this is your swing. If this is lower than this is your swing, right? Because all of this is going to be one leg. Okay, so this is one leg, right? Now it resumes. I think this is the lowest. If this is the lowest, then this is the correct swing. This one here. All right, because I can see some green down there, right? So it means that this is actually the correct swing. This is going to be the engineering liquidity on this area if this is the lowest. Okay, I hope you understand what I just said. So if this is the lowest, then this is your swing, because this is the guy that tapped into the pullbacks here, right? So this guy tapped into the pullbacks here. So this guy led to the break of structure, right? And then he left all these pullbacks behind. The first one I can see here is this one as a valid one. This is the only one that led to the high. So this is the first valid pullback here, right? So this is your inducement. What did he write there? Okay, yeah, inducement liquidity, right? So that's your inducement, and then you have engineering liquidity, right? So inducement, engineering liquidity. If this guy is higher than this guy, it means that this is also your inducement, right? So this is first inducement, this is second inducement, this is your engineering liquidity, and this is your swing structure. I hope you understand what I'm saying, right? I hope you understand what I'm saying. So this is also this is already taking care of the examples I'm supposed to show you, because I'm supposed to just go into the chart and draw all of these lines. But I'm happy that I have the examples here already. So today's session is not going to be a long one. I'm just going to work with what I have here, because it's the same thing. Even if I open the chart, it's still the same thing we're going to see. So what do we have here? Tap. Okay, yeah. So like I said, if he reacts to the okay, I'm so sorry. As I'm looking at this thing, the only thing I'm seeing is my entry, right? So what you just want to see is a sweep of liquidity, and then after a sweep of liquidity, right? You want to see a change of character, okay, change of character, and then engineering liquidity. Market pulls back to the other block. There's an other block here, okay, that is unmitigated, right? So you take your entry, stop loss under here, entry here, and then you aim for at least the highest point here. All right, so you can see you can have up to like 1:7, right? So if you reach 1% here, you can make 7% profit, right? In just one trade. Okay, so it's actually a very powerful way of trading, I must say. It's very powerful. I just need you to understand it very well. If you've been with me for some time, you will understand that I'm not a peripheral person, okay? Because I can just draw the line and tell you, okay, look for this, buy, right? But you don't know anything. You don't know anything, right? You don't know what's happening. And then the market has different shapes and forms, and you need to understand, you need to know why you're using that as the engineering liquidity. You need to know it so that you're not guessing. A person who did this, there is an inducement here and an engineering liquidity. They are not the same, because I have this as the first pullback and I have this as the second pullback. Okay, so what you have here is this is called trend line liquidity, but just the normal way. The first pullback is the inducement, then the extreme one. There's no other pullback here, so this is your engineering liquidity. This is very correct. This is very correct. Market starts to pull back, right? Once the market starts to pull back, what are you looking for? Engineering liquidity is taken. Once the engineering liquidity is taken, right? See, with your normal sense, this is too near. Look at the target, look at the entry. It's too close to each other, right? It's too close. And if you're going to buy off of the engineering liquidity, I'm going to teach you entries, right? If you're going to buy off of the engineering liquidity, you need to see a sweep. When I say sweep, I'm talking about the candle wick, the wick of the candle, right? Not the body. You want to see that this level is swept. If this level is swept, what time frame is this? 1 hour. Then once you see that you have a pin bar here, your work now is to go to 5 minutes and look for an entry from a valid order block. I'm going to teach all these things, right? So here you can see that there is no sweep. There's no sweep. Okay, so you can already know, firsthand that the market is going to go back to either sweep the extreme liquidity, or it will tap the order block and react from there, right? And then that's what you have. Okay, that's what you have. So I don't know why this person has ignored so many things here, but let's go on with this, right? So you have do I have a pullback here? No. Why? Because this is the highest candle here, and then the highest candle wasn't taken out, so this is just one leg, right? So you can see these are all inside bars. There's no pullback. Okay, no valid pullback here, right? And then the market continues. Is there a pullback here? Yes, there is. Okay, so you can see this is the highest candle. The green one is the highest candle, and then see the low is taken. So I have a pullback here. So this is my first pullback, which makes this place what? An inducement. So I have inducement here, which is the same as engineering liquidity. All right, so this is both inducement and engineering liquidity. However, since I am still within the higher high of this area, okay, take note of what I'm saying now. This is the highest point, right, from where the market pulled back to. So if I'm putting that dot I normally put, I'm going to put 1 here, right, as the low, put 1 here as the high, right? So since this is happening inside here, the structure has not been broken yet. So this is not a leg to be considered. Is that okay? So look here. If I'm to draw a line here now, that line has not been broken. So the only thing that is going to start making me say, okay, is there inducement? Is there, before I start looking for internal liquidity, I want to confirm that my external liquidity is standing. That is, there's a break of structure. Okay, so we wait, meaning all these things is just one leg. All these things happening here is one leg until the market breaks structure. Once the market breaks the structure, and then what do you have here? What you have here is the first one. From what I can see here, looking at the grid, the first one was on the wick, right? So after it tapped the wick, what did it do? It reacted from the body. You can see. So we have a valid break of structure here, right? Because it still went, after the reaction, it did not continue to fall. It came back and then it broke this high with the body. Okay, so this week has been exceeded by the body, right? So what it means is that this is what low, this is what high. Okay, this is what lower high, right? So from lower high we have break of structure. Before we now label our higher low, we need to see a pullback that is taking. Once the pullback is taken, we can now say, okay, let's hold our lower high until there's a pullback somewhere here that is taken. So we keep our dot here and we are waiting for the pullback that will be taken here. So once the pullback is taken along this line, once the pullback is taken, we label the high as the higher high. And then we wait until inducement is taken, or engineering liquidity is taken, or whatever is taken, and then the market goes again and breaks structure. Then we now label that place that led to the break of structure as the lower high again, and wait for a higher high. So you just continue like that, and then you're looking for opportunities every day, like that. Okay, and like I always say, you can use any time frame. Okay, there's no need using anything more than 2 time frames with what I'm teaching. There's no need using anything more than 2 time frames. If you're using daily, you're looking for your entry on H1, or you are taking your entries directly on your daily. If you're using M15, you're taking your entries directly on M15, or you go to M1 to look for your entries if you're looking for a more precise entry. If you're using H4, you're doing your structure, a break of structure, change of character, liquidity, all those things. You're doing it on H4, and then you're going to M15 for your entries. Is that okay? So I'm going to teach top-down analysis, multiple time frame analysis, after I teach you the other blocks and then the entry models. Okay, so how you can enter correctly, I'm going to teach all that. All right, so continuing from here, you have break of structure. This person is supposed to have labeled this as break of. Who is this? Who is? Oh, it's the same Pelumi guy. Okay, so should have labeled this as a break of structure. I'm assuming that he missed that, or he probably just went all the way to this point where he had the first body reaction. Okay, but I would have used this one, so I'm thinking he missed it. Okay, so this is actually valid as well. This is valid as well. So that's still fair. Okay, that's still fair. So if I come back to this point, I'm going to say this is the break of structure, right? Because it's the first attempt of this the low is the first attempt of the low to so you can say this is the area where the break of structure became valid, right? That's where the break of structure became valid. Need to stop my notification on the desktop. So this is where it became valid, because that's where the body was taken, right? But in real time, if I'm on this chart, if I see that this is where I expect the break of structure to happen, the market pulls back and then breaks it with the body here, it means that this is now become valid, right? This is now become valid. Okay, so what do you wait for? Pullback. Was this pullback taken? No. Up to this point, another pullback. Was this pullback taken? Yes. Okay, so this is the first time when a pullback is taken. So if I'm to label here as the low, right, my high is going to be the first time when the pullback is taken, which is here. So this is now my new valid structure, swing structure. I hope you get it, right? So this, you can see this is the first pullback that was taken. It means that everything from here to break of structure to here is one leg. It's just one leg, right? And the market pulls back and then gives you again another leg, right? How do you know this is the first pullback? We go again. Now there's a break of structure. Okay, break of structure. We have all of these things happening here. Pullback. So you read it to know if the pullback is valid or not. The first one here is not valid because this is the lowest point of that red candle there. This is the lowest point of that red candle, so it's not valid, right? It's not valid. This is invalid. This one is invalid because you have what? You have just the body. This is just an inside bar, right? So you can see the high, see the low, inside bar, nothing is there. But this one, see the highest candle here, see where it stopped, it was taken. That makes it valid. This one pushes high again, pulls back, right? Inducement. So you have engineering liquidity and inducement here. Is that okay? So you have inducement, you have engineering liquidity, right? I would not refer to this as the engineering liquidity because this is the actual engineering liquidity. This is the first pullback, so that must have been a mistake from him. So we have inducement here, you have another inducement, and then this is the extreme one. This is the first time where the market actually did what? When the market actually gave you a pullback, right? So this whole thing is one leg. If I bring out this leg outside here, what am I going to do? I'm going to have up, down, first pullback, up, then the other pullback, and the other pullback, then up again. So you see, I have three pullbacks here. This is first one, this is the second one, and then this is the last one. So here is the actual engineering liquidity. I hope you guys are taking corrections, right? This is the actual engineering liquidity. So if I'm expecting a valid, you can see, and not to say that that's going to happen all the time or every time it happens here it's going to work, right? So, but because sometimes you can actually have a reversal, right? So, but the argument is that if the market wants to reverse, this is the first chance, this is the second chance, this is the third chance, this is the last chance. If the body closes beyond the last chance, then you have a change of character. That means the market wants to reverse. Is that okay? But if it weaks, you know that it's a sweep of liquidity. It wants to continue up. It's just an expansion. And I said I'm going to show you the different types of liquidity, right? So it's just an expansion. All right. So you're looking at first one, you're looking at second one, you're looking at what? Extreme one, right? So here, see what happened. You can see that his engineering liquidity is very high here, and then it was tapped into, right? Market taps into it, and then it's not even able to get to that high, right? Because this is not even actually the engineering liquidity. Okay, so whatever is happening here, what we're looking for is how the market is going to come back down to this in between these two. Once the market comes back in between these two guys, you should expect a reaction at least, because this is an engineering liquidity. So what you do, entry here, stop loss 2-3 pips below this area, stop loss, target where? Here, target. I hope that's clear. Okay, so yeah, so these ones are the latecomers, right? Because we have passed all this area, and you will not do yourself you won't do yourself any good by not participating in the assignments, because the people who are doing it you can see how I'm taking my time to correct them, because I know that that's how you're going to learn. I'm not giving you assignment because I want to eat, I want to do anything with your assignment, right? It's for your own use. It's for your own use. You see, so, and I told you from the beginning that my mentorship is a drill, and I'm not going to tolerate laxity, okay? Because one bad egg, when you mix it into a big bowl of good egg, it's going to change the taste of all those eggs, going to spoil it. All right, so we're not going to allow you to use your bad energy to corrupt the other guys, and you cannot be on the sideline. Okay, it's either you're here with us, you're going for this thing, or you are not. If you don't have enough motivation, stimulation, or you're not pained enough to achieve success, there are people who are, and those are the people that I'm more than willing to work with. and those are the people that I'm going to give my time to, so that I know that if I'm doing something, I'm actually working with people who genuinely want to receive that help. Okay, so here, I think this is okay, but the labeling, he did some, he did not do some. Came here to say break of structure, which is wrong, because if this is a valid lower high, this is not a break of structure. This is a change of character. Okay, this is a change of character. Change of character is the point where there is a reversal. Once the market beats your lower high, right? Market beats your lower high in a downtrend. It beats your lower high. It's a change of character, right? It's a change of character. What change of character means is we are changing from a character of downtrend to a character of uptrend, right? And then when that change of character is confirmed, as you continue upwards, you are just looking at the break of structure, right? This structure has been broken. You say break of structure. This structure has been broken. You say break of structure. The next one broken. Say break of structure. As you go down from here to here, you say break of structure. Once it's broken, you say break of structure. You go back. You come down again. It's broken. You say break of structure. You go down again. You come in. As it's broken again, you say break of structure. You come down. You go in. You say break of structure, like that. Okay. You go again. Break of structure, like that. All right. I think, who's this? Who's this? Moses, you still have to. I know you are a very busy man. You have to look for time to go over some of the assignments. My review on the assignments. Look at what the other guys have done, and then you should be able to take care of this. All right. So if I'm to correct you here, what you have here, low, high. Okay, if this is up to 40%, it's agreed for basic guys, right? It's agreed. Okay, then you have this push, break of structure here. uh okay, so this you said this is your swing structure, I assume, right? Okay, swing structure. Let's assume you're starting from here. Swing structure, pullback, substructure, right? Minor structure first before it turns to major structure, right? Minor structure first. When there's a break of structure, you have major structure, right? Minor structure first. When there's a break of structure, you have major structure. Okay, and then again substructure, right? Substructure, pullback, correction, pullback, substructure. Then that substructure resumes. It morphs into it will morph into a minor structure. So you need to mark minor structure first. Then when minor structure is exceeded, you now have what? Major structure, right? You have major structure. Okay, so major structure means that the this has been broken. This lower low has been broken. So what do you have? You have a valid swing here. Then you now have what? You have a structure, a swing structure here. Okay, and then if I add what we already know to it, you can see that the pullback here is taken. So once the pullback is taken, you have a valid swing structure here. Okay, so you continue like that until you have your break of structure, like that. Okay, so I think I'm going to stop here. I'm going to stop here because I don't want the recordings to go. Yeah, this is looking correct. This is looking correct. Because I can see break of structure, I can see him marking the internal structure, I can see him marking the substructure and the minor structure and the major structure and the break of structure. This is brilliant. Okay, so this is exactly what I teach, right? This is the correct thing. Okay, so this is the correct thing. So Moses, you need to take a look at this. Okay, so here you have what? Swing structure. Here you have substructure. See this color here is the minor structure, and then this one again is what? The major structure, right? After break of structure, you have what? Major structure. So look at the color difference from here to here. What you notice is that the break of structure is from there. You see it, right? So you need to know all those things so that you can do very well in the test. And there, I think he mentioned it. He said the yellow one like this is swing structure. This is very good. And then this one, he says, is the retracement, or no, retracement is the pullback, is the substructure. Okay, Retracement is the pullback. Retracement is supposed to be the substructure. So this is substructure, right? Sub. Then this is minor, right? So minor structure is this one. That's correct. Minor structure. So you have minor structure, two places. That's wrong. Okay, that's wrong. So apart from that, I think he understands what he's doing. It's just the name that he's mixing up. All right. So take note of the corrections, guys. Take note of the corrections. This is from Kingsley. Thank you so much for your participation. So it's always a pleasure, guys. It's always a pleasure to share with you. Just to clear the air on some of the terms. Okay. There is on the subject of liquidity, right? On the subject of liquidity, there is there are two types, I would say. There are two types. This is the one that the regular people would teach, right? The basic the basic liquidity. Okay, and then there is the I would say the more advanced approach of liquidity, where you understand the concept of liquidity. Okay, you know that this is just the market manipulating people's money, taking it and then moving, right? So the basic one is everything, like let's say the previous, the previous swing high or low, right? The previous swing high or the previous swing low. Something like uh this is the previous swing high, right? If that's the previous swing high, market comes back and then market taps into it, right? So what you have here is what market has taken liquidity of the previous swing high or the previous swing low. Okay, so you can see market has taken liquidity from there, and then what do you expect to continue? All right, so this is a type of basic liquidity sweep. And then if you notice very well, there's no mistake here. What I use is a wick. Okay, that's what I like to see, especially on this type, on this previous swing high and low type. All right, and if you get something like this, it gives you what we call precision entry. Okay, I'm going to teach that when I get to the other blocks. Right, when I get to other blocks, demand and supply, I'm going to teach that. Okay, so that is the previous swing high. There are many types, actually. There are many types. You have this can happen also at the base, right? So what we're saying is market is going up, going up, going up, right? And then it taps this place, right? So it taps. Then you say, okay, yeah, this is previous swing high has been swept, right? So that's a type of basic liquidity. Okay, so sometimes it might be body close, but it did not go far. It just went and immediately it came back down, right? Immediately it came back down. So that's that. I'm not going to take that much time on the other examples. There's the one we call you know what's it called? Double bottoms, double tops, right? We call them equal lows and equal highs. Okay, the equal lows or equal highs, right? When you have equal lows and equal highs, for example, you have something like this: market goes up and then bounces. This is equal high, right? So the market comes back again and then sweeps the liquidity there, right? It sweeps the liquidity. Okay, so you can see these are equal highs. Market sweeps the liquidity and then goes. So this is a type of uh basic liquidity, right? It can also happen on the downside, right? Equal lows. Let me take this down, right? Equal lows. The market comes here, sweeps the liquidity, and then continues up. So you can see the equal lows are taken, right? I'm just giving you this so that when you go out there and someone is telling you equal low, equal highs, equal low, you're going to see this is abbreviated like this: EQH. That's equal highs, right? Equal highs, or EQL, equal lows, right? Telling you that the liquidity there has been swept. Okay, and this is similar to, there's another one we call support and resistance. The support and resistance, or range, right? Range is, they are not, it's almost the same thing, right? Maybe it's longer, right? Maybe it's longer, but it's almost the same thing. Okay. So what you have here is, the market weaks on that thing there, right? It weaks on that thing there, and what you have, sweep, right? So there are different types. There are different types, right? There is the order flow type, right? There's the order flow, or what they call trend line liquidity. There's a trend line liquidity, right? That is, the market is giving higher highs. People are buying, putting their stops under. People who say they're trailing their stop loss, right? This is what trend line. What is here? Money, right? Stop loss here, bought. Stop loss here, bought. Stop loss here, bought, right? So what would the market do? Market take everybody's stop loss, right? It will retrace sharply, right? So this is a type, this order flow liquidity sweep, or trend line liquidity sweep. All right. When you have rising bottoms or rising top, similarly you have like this. I like to see this if the market is approaching, my engineering liquidity. I like to see it move like this, right? I like to see it move like this, so that I can see that, there is enough reason for this thing to move sharply upside, right? So that I can take all the money there. All right. So that's those are basic kinds of liquidity, right? There is previous day high. There's just a lot. There's just a lot. So, but what I want you to understand is the concept. All right. There's previous day high. There is previous session high, right? London session has its high. New York session has its high. That the entire day has its high, right? So if this is what happened yesterday, right? If this is what happened yesterday, this is yesterday's high, this is yesterday's low, right? Today, if the market goes like this and comes back here and sweeps this low, what do you have? This is what previous day low has been swept. So what do you expect? Buy. Okay, and this is an integral part of defining what we call the daily bias, right? So the traders use it to decide on whether that day is going to be bullish or bearish, right? So they look at the daily bar, they say, okay, this is yesterday's bar, right? This is yesterday's bar. Okay, so today's bar has started forming. What is it doing? It goes down, and then it goes is going down, going down, going down, going down. But all of a sudden, what happens? It weaks, right? All of a sudden, it weaks. So what do you know? Once it weaks, it was a full body candle here before, just now. But the next minute, what do you have? It's now a week, right? It's now a week. So you can see that the previous day's low has been swept. So what do you expect? Bullish that day. Bullish, right? That's what you expect. You expect this side to be taken. Is that okay? So those are basic liquidity. Those are basic liquidity. There is as you go on, you might hear all these different names and all those things. Triple bottom liquidity, double bottom liquidity. Do not be bothered by them. What I need you to understand is the concept, right? The concept is what is commonly referred to as stop hunt, for those who do the price action, right? So what we're doing is, smart money. We want to see how we can join these people who are hunting the stops to take the entry along with them. And I need you to understand that you have to give up one for the other. All right. If you're going to take a strategy that gives you a good risk to reward ratio, be ready to take plenty losses. Right? Be ready to take plenty losses. But if you take 7 losses in a row and win once, twice, and 3 times, you have 8% profit if you're using 1:5. So I want you to detach yourself. Your goal is to make your trading boring. Every time I'm asking myself, how can I make my trading boring? I don't want any form of excitement. You see, there are two things I always say. If you think that you can start making money from trading faster than any other person in any other career can start making money from their own career, you are dreaming. That's the first thing I have to say. So the earlier you start working on this thing the right way, the better. The earlier you start journaling your trades and doing everything, the better. And I'm going to teach you all these things. Journaling is a whole class on its own. I'm going to teach that class. Psychology is a whole week. A whole week. The way I'm using one whole week to teach you all these things. A whole week, I'm going to use it to teach you psychology. But when I finish, if your system says you make 20%, you will actually make 20%. Why? Because you have your mental edge. Okay, so we're going to take it step by step, step by step, step by step. Right? We're going to take it step by step. Okay. So this is the basic liquidity. We have if you like, the advanced way of looking at liquidity, which is everything that we have been saying so far. There is the external liquidity, and there is the internal liquidity, right? So the advanced liquidity is either external or internal, right? So the internal is everything that I have showed you, which you now know, right? Everything, inducement, everything inducement. So you see the difference here now. You understand it differently. This is a basic way of just saying liquidity grab and all those things. But this one is structured. It's structured for you to make buying and selling decisions, right? So you have inducement, you have engineering, liquidity, anything that is happening inside of the pullback is an internal liquidity, right? Another name for internal liquidity is structural liquidity, right? Structural liquidity. Or if you like, you can call it what? Continuation liquidity. All of them na grammar. All of them na grammar. The important thing is to know what you need. Okay, understand what is a valid pullback before I can say yes, this is a pullback and this is an area of liquidity. Which one is the first? Which one is the last? Which one is the extreme? Which one is the most recent? Most recent one, inducement. Most recent, followed by inducement. As long as you identify most recent one and extreme one, you have engineering and inducement. All these ones na shakara is just for retail. We call them smart money trap. Why? Because people are buying from here, but the market is not interested in reacting from here, actually, because there's something here it needs to react to. So all these ones is what will form what I call this trend line liquidity here. So all these ones now, as the market reacts from them, what will it do? It will bounce, 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 bounce. And then what happens? It gets to the engineering liquidity area. And then what? To clear everybody, right? So that's the internal liquidity, right? The other one is the external liquidity. In the external liquidity, you have the one that happens at the break of structure. That one is called transactional liquidity. Okay, the one that happens at the break of structure. You call it transactional, or if you want to go for the opposite of continuation, right? You call it what? The correctional, right? You call it correctional. So take note of all this. No, I'm going to give you tests. I'm going to give you tests on all these things I'm saying. And my question is going to come from different angles, right? So you need to know all these things as well. You need to understand all these terms, okay? So that when you're teaching somebody, you know, you actually know it. I always take pride in that thing. I tell you, there's nothing you want to talk to me about that I don't know. I might have a different approach, a different concept, but at least I know I have a knowledge in that thing. You need to master the details of your work because that's the only way you're going to succeed. If not, you have not done. You okay. You're afraid to buy. You're afraid to sell. You know you're afraid that your profit will not. You know you're afraid to take profit. Why? Because you don't know. You don't know what you are doing. You don't know what you are doing. If you know what you are doing, you have the confidence to hold your trade until you reach where it's supposed to reach because you understand it, right? There are two types here. The one that happens at the break of structure is called the transactional or correctional liquidity, and then the one that happens when the swing structure is taken. That one I tell you that the swing structure will be taken, right? That one is called expansion, right? We call it expansion because it's assumed that the trend line wants to expand. If you're those among those who do the trend line thing, there's a time when the market will go like this, and then it will break the trend line. This we call this in normal price action. We call this a break of trend line. So, but what this is not a break of trend line. This is what an expansion of trend line. Once the market makes a new high, right? You see that there's now a new high. Abi? So what was this? This is not a break of trend line. This is only what? An expansion of the trend line. So you can see a trend line that is tiny from here to here, a channel that is tiny can become wider, right? Can become wider. Why? Because of expansion. So if you look at what I drew here very well, you see I did something like this, right? Sweep of the valid structure. Sweep of the value structure. That's called what? Expansion. Expansion. The market wants to go higher. It's not a guarantee that it's a change of character. No. Okay. So what you want to see? If I see a week, I know that oh, this is not real, right? It's not real. The only problem is that most times when this happens, the market doesn't give you any chance whatsoever to get in, right? Because it has stopped every single person on that swing leg. On that swing leg, if you are on inducement, it has stopped you. If you are on any of the inducements inside, it has stopped you. If you are on the engineering liquidity, it has stopped you. If you are on the swing structure, it has stopped you. So it has the highest amount of power to go and break structure, right? I'm going to teach you how to position yourself for this thing, and don't chase it. Don't chase it because the danger with catching reversals, especially for beginners, is psychology. It requires a lot of psychological stamina, right? So I'm going to teach you all those things. So do not be in a hurry. Do not be in a hurry. Okay. And like I said, this thing is going to take some time. It's going to take some time, but you can understand all these basic things at least so that you know. So I've just talked about the expansion, right here, right? So this is expansion of the trend line. Then what you know as break of structure is just transactional liquidity, right? So it's like market has gone broken structure. Once it breaks structure, this is called transactional liquidity, right? So it goes up, comes down. I'm assuming all of these are valid, right? Once it breaks this structure, right, what do you have? It has taken liquidity. Where? Here, right? So it has taken liquidity of this high. What traders are expecting is what? A reaction, a pullback. If it goes again, it takes the liquidity. Once it takes the stops here, right? So sometimes it can go very high. Don't get me wrong, right? Depending on the momentum, okay? Sometimes it can go very high. Now, once it breaks the structure, what we expect is what? A pullback. This is another area where there are stop losses. What do you have again? Market pushes, takes that stop loss. What do you expect? Pullback. All right. So this is what we call transactional liquidity. So I've taught you I've taught you the basic forms of liquidity, all the basic things that people refer to out there as liquidity grab, liquidity sweep, and all those things. And then I've taught you the type that you should know. This is basic, this is what advanced, right? So I'll stop here now. I'll stop here now because I want to keep the lessons as short as possible, right? So what I want you to do for me is open your chart and identify all these things. Okay, look for them. Let me see, right? Look for different types of basic liquidity. Look for different types of advanced liquidity. All right, I know you've already done for the advanced type, but take more. Just take the screenshot and tell me this is double top liquidity. That's equal highs or equal lows liquidity. This is a trend line liquidity. This is previous day low, previous day high liquidity sweep. This is previous swing structure liquidity sweep, support and resistance liquidity sweep. Just label them and go to your charts, guys. If I tell you to go to your chart, go to your chart. Do you think I'm able to come here and teach you all of these things from the top of my head without anything here? I'm teaching you all these things, and it just happened? No, I have seen all, and I know them. That's why I'm able to teach you. Right? So tomorrow, if I tell you to teach somebody, you don't teach the person the wrong thing. Right? So go and learn, go and practice. Go and practice and practice and practice. Right? Practice all these things I'm teaching you, so that by the time we start taking entry, you're not screenshotting nonsense and posting for us on the Chatties group, on the Chatties channel. Right? When you post something, I want to look at it and be confident that yes, this thing is valid. If someone is somewhere, he's less busy, he opened the Discord and he sees the entry, he can take his 0.5% on it and wait for outcome. So everything I'm doing for you here is serious. As I'm talking to you, you see the messages I've been getting on Telegram here, right? The guy wants me to manage the $100,000. That's why he's messaging me, right? So I've told you, the money is not the problem. The money is not the problem. Learn the thing first. Learn it first. Learn it first. Then when you learn, you can now come back and say, okay, is remaining money, right? Learn it. Okay. So thank you so much, guys, for being here today. It's always a pleasure to share my thoughts with you. Do have a wonderful day. Until tomorrow, goodbye.